welcome to Hilltop Wealth Advisors Economic and Market Update for the second quarter of 2020. I'm Rusty Eriksen, and with me is Brittany Mollica. We're both advisors here at Hilltop. And I think it's safe to say that 2020 has gotten off to a start that nobody expected. Certainly, the coronavirus pandemic has had just an unbelievable impact on folks' health and their well-being and finances. And it's worth taking some time here to talk a little bit about where we've been and where we think we might be going. So Brittany, maybe you can get us started with kind of what happened in the first quarter and where do we find ourselves today?
Yeah, sounds great. So going into 2020, the U.S. economy was in a pretty great place. Unemployment rates were at record lows, corporate earnings were solid, valuations were reasonable, and economic growth was slow but steady.
And the U.S. consumer, right, coming into this was in pretty good shape, especially if we look back compared to the financial crisis in 2008 and 2009. At that time, about 12 years ago, we saw very high consumer borrowing, right? So they had a lot of leverage, typically very little equity in homes. Savings rates were low, and compared to where we are in 2019 and 2020, coming into this, consumer spending was much more of at an appropriate level. The debt burden was not nearly as large, and we actually saw a pretty high savings rate.
Yes, that's definitely fortunate that we were in such a stable position. And it's interesting, the beginning of the year, we were focused on things like tensions in the Middle East, developments with Brexit, and progress or lack thereof towards global trade deals. But things have changed so fast. It was mid-February when the S&P 500 hit an all-time high, but by mid-March, markets were definitely in bear territory, with businesses closed and events being canceled. And March 23rd marked the lowest point, with about a 34% drop from that peak just a month earlier. But what's important is that the federal government acted very quickly. The Federal Reserve cut rates twice and has implemented unlimited quantitative easing. As you can see in this chart here, the Federal Reserve's balance sheet has grown tremendously as part of that effort. And the CARES Act was also signed into law in late March. So that provided some relief to individuals and also small businesses.
And I think it's significant, once again, to compare what we've seen in a very short period of time to 2008, 2009. In the financial crisis of 12 years ago, the response from the Federal Reserve as well as from the federal government was much slower and not nearly as large. And so I think that's a significant difference when we compare what we experienced then versus what we're seeing now.
And that difference has really helped support the markets. Through April, we closed at just 15% below that peak from February. But looking forward, it's a lot harder to forecast what our near-term future looks like. There are so many unknowns, from when and how the economy will fully reopen to if a vaccine will be developed this fall or early next year. And we are neither economists nor scientists, so we won't speculate too much about those items, but we do think it's likely that we'll see the worst economic data since the Great Depression. So starting with unemployment, over 30 million Americans have already filed initial unemployment claims, and economists think that we might see an unemployment rate of above 15% for April.
Which is significant, and it's definitely worth taking a moment and thinking about that. I would say a couple of things. One is that it largely, I think it's well understood that those numbers are going to be so big and very bad. But I think largely those are priced into the market at this point. Also, I think it's worth thinking about how those unemployment numbers are different than they've been in the past, right? So part of the response from the federal government is to kind of broaden who's eligible for unemployment. And if we look at some of the data that we have so far, it looks like a lot of that unemployment is related to furloughs. So hopefully folks who are just temporarily not working. And the hope would be that as the economy begins to reopen and folks can get back to work, that they will in fact be able to return to work. And that's a very different scenario than for folks who have permanently lost their jobs, right? That will take longer to recover from and longer to heal. So it is worth recognizing those differences in unemployment numbers now versus in the past.
Definitely. Another economic data point that we'll be watching for is GDP. First quarter GDP estimates have come out for a contraction of almost 5%, but first quarter was just January through March. So that only includes 2 real weeks of the social distancing. So it'll be really telling to see what second quarter GDP comes out as. It's predicted anywhere from a contraction of 15 to 40%, which would definitely put us in recession territory.
And that's something that it's hard to know exactly when you start the recession. You only have that data, when you're looking backwards. So it is very likely we are in a recession. And historically, recessions have been somewhat persistent. And what I mean by that is they've lasted more than, just a couple months. There is a lot of discussion from investment professionals and economists that we talk to and read that there's a potential that the recovery could happen pretty quickly. Oftentimes, folks will use different letters to express what they think the shape of that recovery could look like. So we've certainly heard from folks who think the recovery could be like a V shape, so pretty swift decline, but also a pretty dramatic and swift recovery. I would say most of the folks that we talk to tend to favor a U shape, one where we'll see a recovery over several quarters. So hopefully that could begin here towards the end of the second quarter, but will likely be phased in over the third, fourth quarter of this year and also the beginning of next year as well. But nonetheless, a recovery that we do expect to be there. The biggest risk that we continue to hear about is just if there's a second wave that leads to more social distancing or going back to the social distancing that we had before. So we recognize this is, a multifaceted issue that we're dealing with. And so not only is it, when is the economy ready to reopen, but when are individuals and consumers, when are they going to be comfortable going back and doing some of the things they were doing before, like going out to eat, going to the gym, getting on airplanes, going on cruises, a big part of what folks were doing before. When will they be comfortable doing that? And it seems like there's a lot of expectation that that can begin to happen, but maybe that really begins to happen much more when there are viable therapeutics or even a vaccine, which will be hopefully not too far down the road.
Definitely. So a lot of unknowns right now. But Rusty, why don't you talk a bit about how we're managing for some of these concerns?
So for us, we really think financial planning is key. And for all of our clients, when we think about their financial plan, we want to break it down really into 3 time frames, right? The immediate, what are we expecting and needing to plan for over the next 1 to 2 years? Those intermediate time frames, what about the next 2 years to 5 years? And then those long-term time frames, right? 5+ years, 10+ years down the road. And we certainly have clients that are all across the spectrum, right? Where some are in retirement right now. And so, their short-term goals are going to be more around liquidity. How do they wisely manage their investments that they're using now to live on in retirement? Whereas we have clients who are, much maybe younger, and their shorter-term goals are how are they saving for their kids' education, children going into college in the nearer term, and retirement is still maybe several decades away, and they're in the position of being able to invest money in the markets during this time. So those are some unique situations, right? And they're going to be, it's important to plan for those as they relate to everybody individually and particularly.
Definitely. And in terms of investment management, one strategy that we have taken advantage of during this down market time is called tax loss harvesting. And that's when you sell a position in a taxable account that has experienced a loss, and then you buy a very similar position, so you're keeping the same asset allocation. But doing this allows you to take advantage of that loss, tax-wise at least, to help offset any realized capital gains.
And I think that can be a wonderful thing to do at this time, particularly given that at the beginning of this year, we found ourselves in the position of taking profits and rebalancing in portfolios. So gains were realized within taxable accounts. And so doing some tax loss harvesting can certainly help minimize some of the tax impact when folks do their 2020 tax returns. We also are making some changes to the portfolio. I would say that more is staying the same than changing, and I think that's a key point to underline. One of the changes, though, we are implementing, though, is we are increasing the alternative sleeve within the portfolio. So this is part of the portfolio where in the past, and we currently use it for looking for opportunities where we think there may be some investments that are undervalued that we particularly want to have more of an allocation to, but also a piece where we've also used it as a buffer, too, when we think that maybe we want to look to de-risk the portfolio, add positions that have less volatility, then we look to implement those primarily within the alternative sleeve of the portfolio. So having a bigger alternative piece within the portfolio gives us an opportunity to maybe tilt the portfolio one way or the other a little bit more dynamically at this time.
Definitely. Our most important recommendation, though, is to understand how your investment portfolio fits into the broader picture of your financial plan and how market volatility might affect your progress toward your financial goals. This is something that we're going to be proactively discussing in client meetings throughout the summer, particularly reassessing risk tolerance and rebuilding cash positions. So thank you all so much for watching, and a special thank you to the healthcare workers on the front line. We hope you all enjoyed this video and learned something, and we are always here to talk, but if you're looking for more information, check out our website and the Hilltop Views blog.